Hello everyone. Thanks for tuning into the series on global macro. In this first part, Debashis spoke about how the global financial markets have evolved over the past 2 decades and how the various asset classes have performed. In the second part, he laid out the probable paths ahead for the markets, especially in the light of unprecedented monetary policy action by the global central banks to deal with the COVID-19 pandemic. Although he was supposed to talk about gold in the previous session, we thought it would make sense to have a separate session given all the controversies and misconceptions around investing in gold. So in this part, Debashish will talk about the investment case for gold and how to think about it in a portfolio construct. Over to you, Debashish.
Thanks, Mohit. So let's start on the most topical part of markets today, which is what's happening in gold, and it's actually pretty surprising, how quickly sentiments have changed towards it. Where barely about a year or year and a half back, I think there was next to no interest in gold, and suddenly from there we've reached the situation where almost every second conversation today is tending to be around gold. So what we really try to do here is actually explore, how gold works. How do, we all of us spend a lot of time trying to figure out, fundamentals of a stock or technicals of a stock and so on and so forth. So we'll kind of try to use the same construct to see how to look at gold from an investment framework point of view, and then use that to draw our conclusions in terms of what one should do about gold in the coming decades. So to start with, let me just separate it out into three parts, which is a fundamental framework for gold, a technical framework, and a behavioral framework. The fundamental framework is really what's in play most of the time, which is how gold relates with real rates, and this is I'll obviously go into this in a little more detail in the following slides, but just at a headline level, what it really means is, see, gold by itself does not pay a coupon. It does not pay any interest. So depending on whether there is actually returns available by investing, say, in a bond, after you have netted out the impact of inflation, and that's known as a real yield. If you see that the returns are available, you're getting a positive real yield, it makes no sense to own gold. And if you're not getting a positive real yield, and in fact your returns are negative after you've taken out the impact of inflation, in that point there is a strong case to own gold. So that's the very basic relationship, and this tends to hold across cycles. At a more technical level, and this really becomes applicable more for very, very short-term phenomena, is the case of kind of looking at what the demand supply dynamics are and what are the elements of this demand and supply, and we'll kind of go into that in a bit down the road. And the third part, which is possibly something which is going to become more and more important maybe a little later in the decade, is the more behavioral aspect of it, which is gold's role as an alternative currency. Now today I don't think we're quite there yet. You will know when we get there. I don't think anybody will be under any doubt. It will be a scenario where there is a serious concern on the viability of the currency of whichever country we happen to be in. So let's just go deeper into these three factors. So firstly, just continuing that little introduction which I gave to the relationship between real rates and gold. Just to recount, real rates is nominal bond yield, the yield which you see on any bond that you're buying today, minus inflation, because when you net out inflation, that's really the actual return that an investor is making. So when real rates tend to be positive, it basically says that makes more sense to just buy the bond, which is giving you a positive real rate, versus gold, which by itself will give you more returns. So you would prefer to own bonds in that case, and therefore demand for bonds will tend to be a lot higher than the demand for gold. On the other hand, when we have negative real rates, that's a time when you're actually making no money by owning the bond, and therefore you're better off just owning gold, because not like it's paying an interest, but it's better than actually making negative returns, which are getting eaten away due to inflation or other factors. And therefore, at that time, gold becomes something to own as opposed to bonds. We can plot this correlation over time and actually see how it looks like. So what we've done over here is we've just taken the real yield on the 10-year bond in the US, and you can take it against other benchmarks as well, just because the dollar is the reserve currency and gold also tends to be followed worldwide in dollar terms. It just makes sense to do this comparison. And what you can see is the dark line is the 10-year real yield, which is the 10-year bond yield minus inflation, and that's just been inverted. And what's plotted against that is gold prices. So what it's really saying is that when the real yields tend to go down, so if you invert it, it will look like it's going up. That's when it will tally with also the performance of gold. And if you recall what I was just saying here, when real yields are negative, it makes sense to own gold. Real yields negative means in this graph, it will look positive because we've inverted the real rate curve. And that should tally exactly with gold. And that's exactly what you're able to see over here. So if you just track this correlation, for the most part, this will tell you what you need to do. Now, let's look at what are the scenarios in which we get negative real rates and what are the scenarios in which we get positive real rates. And it's an outcome of the kind of economic and financial environment we are in at any point in time. But therefore, if you are able to evaluate this part, it becomes relatively easy to think about whether to own gold or not. And you honestly don't even need to ask that question of anybody. So firstly, let's look at when do we get negative real rates. So if you recall the formula of real rates, which is nominal bond yield minus inflation. So we'll just take that up over here. So when inflation is very high. So what happens is that the actual inflation tends to increase at a faster pace than the pace at which bond yields rise, and therefore when you do A minus B, which is bond yield minus inflation, it tends to be a negative number. This is intuitively what we have grown up with, where whenever the conversation is around severe inflation happening, the almost Pavlovian reaction to that is to go and buy gold. However, we are not really in an inflationary environment right now, and yet it's been good for gold, and it's been one where real rates have been negative. And why that's happened is because of a unique set of factors which have happened now. So while we have mildly positive mildly positive inflation right now, probably sub 1% at best, but we also have witnessed for the first time, and I think in human history, somewhere around 0 to negative bond yields in multiple parts of the world. So again, when we put it into that equation, let's assume your bond yield is 0 or mildly negative, and then you subtract a mildly positive inflation from it, it still ends up being a negative real rate. And that's where it is. This is what started happening about a year and a half back, or maybe a little more than that. That's, the real rate started going towards negative territory, and which you can take a look at the graph over here. If you see the part starting from mid 2018, where you'll see that the real rate in this curve is starting to go up, which basically, because it's inverted, it means actually the real rates were tending towards negative territory starting from mid 2018, and therefore simultaneously gold started going up. So pretty easy to figure this out if you were just aware of this relationship. On the other hand, let's look at scenarios where we get positive real rates, and which therefore end up being not so good for gold. When does that happen? When we face a deflationary environment. What deflation means is negative inflation, or basically inflation is falling faster than the speed at which bond yields are falling. So again, when you do A minus B, it basically becomes A minus a negative figure, which actually becomes A plus B in effect, and therefore you get a positive real rate figure. It can also happen in a scenario where interest rates are already negative, but bond yields are falling. Inflation expectations are falling even faster, which can potentially happen during, maybe even a depressionary kind of environment. And that's where real rates essentially can turn up. So whenever you're faced with deflationary scenarios, do keep in mind that gold will not work. Now the question is, when did we face these scenarios? And I think a good example of that is 2012. I talked about this in the first part of our presentation where I was describing currencies and the impact of the yen. So feel free to go back there and refer, but I'll just sort of recount it over here just for the sake of completeness. What happened at that time, why gold peaked around that 2012 period, was that at the time, again, people were worried about inflation and they had been buying gold, and therefore gold, kept going up, and you got almost like the high prices which came at the time. Subsequently, Japan came and changed its policy in terms of its yen currency policy. So they said that, they had been following an appreciating yen policy, which is the yen kept going up all the way from the mid 80s to 2012. So even though they were slowing down as an economy, but they are a big exporter, the prices of their exported products did not come down in value because their currency kept going up in value. However, in 2012, when Shinzo Abe got elected, he reversed that policy, which meant that now the yen would start falling, and therefore their exported products would become cheaper, which means anybody who was competing with Japan would also have to do exactly the same thing. And if you look at, the kind of goods which you source from Japan, the direct competitor is somebody like Germany, whether it's in cars, in heavy industries, etc. Someone like Korea, and also China. So Germany effectively represents the euro currency, which is the second biggest currency bloc after the dollar. And Korea and China sort of represent the heart of the Asian industrial space, except Japan, and therefore almost a big part of the Asian currency system. So the impact of Japan reducing its currency effectively meant both the Asian majors as well as the primary European exporter was left with no choice but to weaken their currencies as well. So this meant that as currencies of all exporters started coming down, prices effectively started moving down for goods and products, and in turn, which means a deflationary environment started coming in exactly when everyone was positioned for the opposite, which was an inflationary environment. And therefore, you saw that sell-off in gold in 2012. We are approaching something similar today, but we'll cover that in a little later as we look at the outlook going forward. So just to summarize, positive real rates, not so good for gold. Negative real rates, good for gold. Okay. Next, let's kind of look at the demand supply scenario for gold, and that's more on the technical aspect of it. There is the physical demand and supply, which comes in from, whether it's jewelers on one side or if it is, being used in certain technology products and all that. But the bigger demand really tends to come from people using it from investment purposes. So over the last few years, on the margin, the two big players in this market have been A, central banks, because central banks themselves have been buying gold, and B, the ETFs, the gold ETFs, who also tend to be buyers of gold. And they have really been moving the demand a lot more. Because if you look at these charts, what it will tell you is, while the demand for jewelry tends to be relatively stable, the demand, let's say, from ETFs or from central banks tends to vary somewhat more. And what it therefore results in is, so you've got the physical gold market, which is, the physical metal being traded. But then you've also got the futures market, which is where the financial market participants primarily comes in, which is gold futures. But, we have that in India as well. And obviously it's available all over the world, with London and Chicago being the big centers. And that's where you have different types of market participants. there could be a lot of these hedge funds who are known as CTAs, commodity trading advisors, which are essentially a lot of these guys who are running systematic trading strategies across multiple commodity markets, and usually a lot of that tends to be in gold or oil, the big liquid markets. You also have a lot of the ETFs, which are participants in the futures markets because they tend to take their positions in futures and later they may, as and when they get hold of physical supply, they may do it. Some of them may not also need to be completely holding, physical supply. Of course, there are some of them who are, as per their mandate, they have to have the actual physical to back up the holdings of the ETF. So these again, because like in any market, like in any futures market, as you'd probably be well aware of in India also, whether, not necessarily I'm talking gold, but any futures market, there is always, quick build-ups or cut downs of open interest, whether, build-up of long interest will sometimes drive things one way, there could be short interest building up on the other side, which will impact how prices behave in the short to medium term. So equally, gold tends to have that impact. And general rule of thumb would be if too many people are long in gold, the way you get the data there is you have data on speculators, and then you have data on the what is known as the commercial hedgers, which is basically people who are just taking the opposite side of the trade. Usually it's the broker or the investment bank who's doing that. So if too many speculators are taking long positions, then normally you can imagine some sort of mean reversion will happen down the road, where if too many people are long, then probably makes sense to be contrarian and go short. And similarly, the other way around, if too many people are short, then there's a good chance of a short squeeze and prices may rise. The actual availability of physical gold also may impact, may have a technical impact from time to time. Some of this was felt during the COVID time, where I think physical demand was sought after and not necessarily, it could not be supplied immediately because of the lockdown issues. They seem to be a lot lesser at this point, at least as one gets the sense. So therefore, the physical and the futures market have tended to be much more in lockstep currently. But do expect, there could be times where if the gold prices are significantly higher and therefore much more sought after, the chances of, short squeezes or insisting on physical delivery and all of those things can really start becoming much bigger factor, which influence the very short-term movements of gold prices. Okay. So moving on from here, let's next look at the third factor, which is possibly going to be the most important factor down the road, and that is what happens if, from a behavioral standpoint, you start worrying about the currency system which you are in at any point in time. So, I mean, classic example being if you were in the likes of Zimbabwe or Venezuela over the last decade or two, it's pretty obvious that, you would have very little faith on your currency, and therefore you would look to park your money in other assets. Now, whether those assets are like gold or it could be other physical assets as well, whether farmland or natural resources and things like that. So that's a very obvious sort of thing that starts kicking in. And given where we are with central bank policies, this is not a, one can say, an inconsiderable risk. I don't think it will happen immediately for the simple reason that as of now, we may still need to go through one deflationary cycle. And this is something which we've covered in part 2, and I'll sort of come back to it again. But down the road, if the amount of money printing required to come out of the deflationary cycle is extremely large, where the amount of money which we're printing, I mean, the money we're printing today is still fractions of GDP, like maybe 20% of GDP or 15% of GDP or something like that. But the amount of debt which is there in the world is significantly larger than the GDPs themselves. And therefore, if you're forced into a situation where you have to bail out a lot more of the debt which is out there, the private debt which is out there, and therefore you may need to print money which is multiples of GDP and no longer fractions of GDP, that could mean a very legitimate concern on the uh, the future viability of the paper currency. And this is not the first time it's happened. It's happened in history plenty of times. And in all of those things, then the real fear is whether money itself will hold value or not. Then you will actively start reallocating to other assets, and gold, having held value through centuries, will become a very, very obvious choice. And that's kind of really what we are going into over here. Whereas the Fed has expanded its balance sheet, we've seen you know, build-ups in gold. Having said that, like I said, I don't think it's so much of an issue immediately. So if we were to kind of look at it in a near to mid-term, I think we are, as of now, probably some amount of excess is happening. And I'll just, get into a little more nuanced sort of description of it. But in the near term, we may be approaching some sort of a peak in gold, and I think we'll be probably a month or two away from it. But over the longer term, I think certain reasons will come about, especially the sheer amount of money printing which would be required to bail out the system, and which is where the real big bull market for gold will come up with. And I'll just go into that in a bit more detail. But before I sort of jump there, let me just summarize all the thoughts which I put together just to give you a framework to evaluate gold, which is one, the fundamental framework in terms of how gold is behaving versus real rates. They tend to have a negative correlation. When real rates are negative, it's good for gold. When real rates are positive, not so good for gold. That's your easiest way to take a call on whether to be owning gold or not at any point in time. From a very short-term point of view, for those who are interested in trading, say for a few weeks here or there, it may make sense also to evaluate supply-demand dynamics. Within that, the bigger driver tends to be futures markets. So therefore, just looking at open interest, long interest, short interest, things like that will be of use to determine which way to participate. And lastly, and probably the most important part which will happen down the road, which is the use of gold as a store of value, as an alternative currency, which can happen should the current currency systems come under pressure, or there may be a serious doubt in the viability of the current paper-based currency systems. And at that point, gold would be looked at as a reserve. It's no longer then about fundamentals and technicals or anything like that. It's no longer about trying to make money. It's more driven by the fear of losing the value of money itself, which would be the driver of gold prices. And therefore, that can really create the big move in gold at the time. So now let's just go back to the sort of view, and this is something which I've touched upon in part 2, but I'll just try to go over it again, just to give you the framework of how to plan the investments into gold. So just to recount, you may have seen this before, but even if you haven't, currently we're in a bit of a liquidity driven phase. Liquidity being created because of the money printing which the Fed and the other central banks have been doing. Also matched by the fact that moratoriums, etc., are in place almost all over the world, which means interest payments are not due. There are large interest payments which are otherwise there because the amount of debt in the world is several times the size of GDPs. But since there's a moratorium of some sort or the other all around the world, it's not due right now. So therefore, there's nothing to suck the liquidity out. Also, with the shutdown, the lockdowns and all which are in place, the avenues of spending money have also shrunk dramatically. And therefore, there's liquidity, there's very little place to use it. There is some amount of money printing going on, which is obviously creating future inflation worries. Although I would hardly call it too much of a worry at this stage, it's still fairly mild, but at least the belief is growing. And on the back of that, it's been a fairly conducive environment both for stocks and for gold. The results also don't particularly matter, which is why what's helped for stocks at the moment. And as far as gold is concerned, with low interest rates and mild inflation, it's created a negative real rate scenario. coupled with money printing which is going on, which creates some element of future inflation fears. And that's a very, very powerful environment for gold. And that's what we're seeing right now. This may continue for some time, but the rising, and just, I'll repeat this again, the rising price of gold may actually set the stage for its own, I would call, large correction, which is probably pending maybe in 2 to 3 months from now. And I'll just explain that in a little more detail now. So as gold starts rising, the expectation of inflation keeps building. Now, by itself, that is not a problem. Central banks have kind of been wanting that anyway. However, if it tends to be two scenarios start happening, which is one, that gold itself is rising as opposed to other assets, and that can create the view that people are, what I mean by that is, let's say gold rising faster relative to, other commodities like copper and things like that, which have actual industrial usage. It can mean that people are less worried about inflation per se and more worried about the viability of currency down the road because of the actions of central banks. So that's one. Secondly, a lot of money also went into the US over the last 2, 3 years and was parked in US government bonds because, if you're just basically planning to deploy money in the US, you're a fixed income investor. You want to own the currency and therefore you then do the next thing, which is buy the bonds over there. Now, till about 15 days back, the bond yields have been pretty much the same as what they were, post that COVID fall, which is they were about 0.5, 0.6% on the 10-year bond, and it's still about the same. So per se, you were not really making or losing money on it till about 15 days back. However, since the last 10, 15 days, while the bond yields have stayed the same, the dollar has been falling. And it's fallen about 5% odd since then, which meant that in your position, you have actually just, especially if you were an investor from outside the US, which is really what had been the case over the last 2, 3 years. Lots of foreign money had gone into the US. If you were an investor from outside, you've just lost 5% on your position. And that's if you were unlevered. Typically, a lot of investors in the bond markets also tend to be levered. So, they may have multiple levels of leverage. It could be 3, 4 times levered to 10 times levered, could be anything, which means you might actually, because of the currency movement, be losing quite a bit of money. And in those scenarios, you may either just unwind your position, or in case it's more like an opportunity cost, which is building up for you, given that most other assets around the world are running, whether it's gold, whether it's stocks. I mean, multiple markets around the world are making high or reaching close to their highs. The incentive will be very strong to withdraw that money which had come in droves, parked itself in dollars and in government bonds in the US. It will start moving out of that and moving on to these assets which are having momentum right now, including gold. So this may create this sort of virtuous cycle in some ways where money flows out of the dollar and out of the government bonds. The bond yields start rising, which in fact forces more money to go out. That in turn, and this is accompanied by the dollar also weakening as the money leaves the dollar and goes and deploys itself in multiple other assets. People anticipate that and sort of get on that trade on top of it and sort of reinforce that movement. And that money goes and finds its way into gold or into other equities, and kind of again provides a tailwind to the current momentum you're already seeing. So you may have this scenario over the next 2 months where actually price appreciation in gold, equities, etc., in fact accelerates. The fall, it is accompanied by a fall in the dollar also a little further, as well as a rise in bond yields. Now, once this rise in bond yield starts happening, that's the part which has not happened as yet. Everything else has already happened or is happening. Once bond yield starts rising, that presents a real problem for the Fed. Why is that? One, their cost of borrowing for the further amount of money which they would be printing to, keep bailing out or buying bonds and things like that, that will start going up. Secondly, a rise in yields accompanied by a rise in gold prices creates the fear that the central banks may potentially lose control and that can further undermine confidence in the central banks. And given everything over here, the whole borrowing program, quantitative easing, whatever we may call it, is predicated on the fact that people still have faith in central banks. That is a scenario they would want to avoid. The third part, and that's a slightly complex part, but if you recall, I had mentioned about the size of these various markets, the equity markets, bond markets, and the derivative markets. The big collateral for derivative markets tends to be the safest government bonds, which is the US government bonds, German government bonds, and Japanese government bonds. If one or more of these start to lose value, and given how low the bond yields are, any movement can cause a significant drop in value. Because hypothetically, if your bond yield moves from 0.5% to 1%, your bond value just went down by 50%. So that creates a situation where the margin which is kept for these derivative trades has suddenly started losing value, and therefore the counterparties will start asking for margins, which creates a big problem of trying to find margins from somewhere. So and that can put severe stresses on the system, because the participants in that massive derivative markets are large financial institutions, and if they have to go hunting for margins, it can pose systemic risks to the financial system. So putting it all together, combination of rising bond yields and rising gold prices coupled with a weakening dollar can put some doubts on the faith in central banks themselves, and in turn create a bigger problem for central banks. And therefore, the incentive may come for the central banks, especially the Fed, to reverse its current policy stance. The current policy stance is extremely easy liquidity and providing support to the bond markets, and which has really fueled all of this liquidity-driven gush which we are seeing. All they really need to do is probably make a statement of some sort that either we are opening up the moratoriums, or we are not going to be supporting as much, or we're going to reduce our purchases. Something which is not as expansionary as what is going on right now can completely reverse the current momentum which we are seeing. As you may recall, back in February, March, all it took was 1 week of falls to completely change the perception and the sentiment, and similar things can happen. My current timeline of this is somewhere around September, October is when this thing comes in, and we may see accelerated moves in equities, gold on the upward direction, and accelerated moves of the dollar in the downward direction, leading up to that phase, which causes some amount of rise in bond yields in the US, and therefore an incentive to change the policy stance. Changing the policy stance can then usher in the deflationary phase, wherein debt issues might arise. This can create two situations. One, if you do not have the cash flows to pay for debt, you may need to liquidate some of your assets to do it, and that creates a potential sale because of margin driven selling, a concept which in the markets you'd be reasonably familiar with. And also what it does is, because banks who have lent the money are a little unsure what kind of recovery of money may happen or may not happen, they may also tend to put a leash on the amount of credit which they're allowing to go into the economies, which in turn can have an economically, a deflationary impact from an economic standpoint. So the first part, which is margin selling, can have a deflationary impact from the more financial market standpoint. And the second part, which is banks not lending out as much credit, can create a deflationary impact from the economic standpoint. The combination of this can create a deflationary wave. Deflationary wave in turn creates the negative inflation kind of scenario, which can cause real yields to become positive. They're currently negative, but they can suddenly flip to the positive side. And that is not so great for gold, and you may see a fall in gold prices. However, what may the fall in gold prices, before I get to what happens beyond that, the fall in gold prices may be different from one currency to the other. It may be larger in dollar terms, because the dollar is likely to strengthen during this deflationary period, because in a deflationary period only cash works. If I look at it at a global level, dollar is the global cash. So there will be a demand for dollars. A lot of the debt is also denominated in dollars, and therefore the demand for dollars would increase during that period. You could actually get a fairly good trade by being long dollars during that time, especially against other developed markets. But coming back to the point that gold will not work very well, it will fall more in dollar terms. It may fall less in rupee terms, simply because the rupee may depreciate during that phase versus the dollar. And but it's still likely to undergo a reasonably deep corrective phase during this time. This could even create a scenario where maybe a year and a half down the road, the interest level in gold may not be anywhere close to what we are seeing today. That shift in sentiment is something which you should watch out for, because I think that will be one of the cues to decide when to come back in again on gold. And I'm talking this very specifically because I think there is a bigger bull market in gold over here, unlike maybe a lot of other asset classes where they may or may not be. But in gold, there is a bigger bull market which is out there, and what we're likely to see is more a deep correction than necessarily a reversal in gold itself. The big trigger for that bull market will be the response to this deflationary phase, which will involve a significant amount of monetary plus fiscal stimulus. Fiscal stimulus hasn't really been the story in the last decade or so, except the brief period where Donald Trump lowered taxes, and then multiple other countries, including us, followed suit. But that time monetary policy was going the other way, where they were raising rates. But going forward, both of them will have to be in tandem. However, fiscal will really need to take the front because with interest rates being so low, monetary policy only has limited use. And on the second side, the unemployment levels are extremely high at this point, and therefore you'll need to do fiscal expansion to either bail out industries, create investment opportunities, give incentives to drive investments. So things like that will happen, including whether it's infra investments, whether it's reordering of supply chains. All of those things we'll start seeing. The response to that will need to be fairly expansionary from both a fiscal and a monetary front, which will over time start creating real inflationary situations, as well as a real worry on the viability of paper currencies. And that's where the big bull market for gold likely starts. And if I were to just try and put some numbers around it, the actual amount of gold which is out there is about $10 trillion. The actual amount of dollars circulating is about somewhere in the range of $50 to $60 trillion. So if we are to imagine that there is a potential that dollars may not continue as the reserve currency down the road, I don't think it's a situation today, but down the road, and that can happen if the dollar strengthens a lot against other currencies, which will really hurt every other currency. And that can happen during this deflationary phase. And because every other currency hurts, there may be a consensus to change from the dollar system. That consensus does not exist today, and that's why I'm saying it's not a possibility right now. Also, there's too much debt denominated in dollars, and therefore changing the system today will create a lot of losses for lenders, which may or may not be something desirable at this point. So down the road, you may see that consensus building, and if there is a chance of a shift from the current dollar system to something else, nobody will really know what the new system will be. So gold becomes the place to park money. It could also be Bitcoin to some extent, but we'll see what the regulatory structure is around Bitcoin at the time. Gold also, I mean, it's not improbable that around that time some kind of restrictions on ownership and all those things may come in, but it would be a fairly bullish environment for gold at that time. And therefore, if you were to just do the numbers, about $50-60 trillion worth of dollars actually in the system versus 10 trillion of gold, assume they meet somewhere midway, and you're looking at least a 3x increase in the value of gold. Of course, things don't work that rationally. You'll see irrational behavior on either sides, and there's a good chance you see irrational behavior on the upper side of gold as well at the time. So that's really sort of the view on it. In terms of an investment strategy, I think you should look to allocate across the 4 ways in which you can allocate money to gold, which is: 1, you should have some physical. Because do keep in mind, while I'm talking, in a very normal way in a lot of the scenarios which I'm describing over here, the reality is they will really hurt people. And when that happens, there is no guarantee markets will be functional or not. Especially if a hyperinflationary scenario happens, we really don't even know what parts of the system will function or not. And owning the physical asset will have value and at least some sort of safety value to it. So do make sure you own some amount of that. Secondly, also look at sovereign gold bonds. I think they're probably one of the best assets out there, simply because they also actually pay a coupon. So you're not, your hurdle is not zero, but instead about 2.5%. Also, if you own it more than 5 years, I think you get capital gains exemptions on it, so which does make it very attractive. There is a secondary market for it, and therefore, it's if somebody really needs to liquidate, it's definitely possible to do so. Extremely attractive instrument. Uh, Thirdly, look at gold ETFs, of course, because they just give you the easiest way to play gold price, and easy to get in, easy to get out, enough liquidity and all that. And lastly, you should also look at gold mining companies. The reason, and I'll describe that in a little more detail here. The way gold mining companies work, I mean, these are companies which own gold, which mine the gold. And the way they work is that they have a particular cost of producing that gold. And if the prices of gold tend to be higher than that cost of production, then they will make some money. So today, the cost of production is about $1,200 per ounce. Uh, Now, about a year back, the gold price was also about the same, so they were making no money. However, now with the gold price at about $2,000, they're making about $800 of profit. So from almost zero profits or maybe $100 of profit, they've gone up to $800 of profits. So the mining companies will actually, they tend to see a dramatic growth in their profits, and therefore you're likely to get much higher rates of appreciation as and when gold prices are going up. It can go the other way when gold prices are going down. It can also fall much quicker. Typically, what we've observed is that if gold prices were to go up by X, then the profits of gold miners tend to go up by about 2.5x. So they actually add a bit of leverage into your uh, view of gold prices going up. So assuming you were to allocate 10% to gold, so maybe put 2%, 2.5% in physical gold, 2.5% in sovereign gold bonds, maybe a couple of percent in gold ETFs, and again about 2.5% odd in the gold mining stocks. Those will be in effect almost like having an exposure of about 6-7% as opposed to the actual deployment of 2.5% of cash which you put in towards an appreciation in gold. And I think I must mention this, full disclosure, because our AMC does have a fund which invests into these kind of companies all around the world. So I do have an incentive to tell you about it. But having said that, it is something which actually does add value, and therefore I thought it makes sense to bring it out over here. Because gold mining companies don't really exist in India. Most of them are there worldwide. They've also had a fairly good a period of 6-7 years from their own operating point of view, where they went through a lot of trouble with gold having peaked in the previous cycle in 2012. So they had also they suffered from doing a lot of capacity building at that time when gold prices fell off. They went through a lot of cleanup of their balance sheets. They are very strong cash positions. Even if gold supply were to be, because of lockdowns, if they were to be shut down, they've got enough cash to ride through that period comfortably. And they do own the underlying gold asset at the end of the day. So the same logic which applies to you owning physical gold, the next best thing to that at times is also owning somebody else who has reserves of gold, and that's where it comes in. So that's really it on gold. The path I think I've laid out over here, probably a continued appreciation which we see for the next couple of months or so, followed by a fairly deep correction. The response to that correction may involve a significant amount of money printing, which will be extremely powerful for gold in the long term, wherein inflationary expectations will start building again. And then once worries about currencies build up, gold will probably be regarded as a sort of alternative store of value or an alternative currency till we reach whatever the new system might be. And that's where you may see the entire bull market of gold playing up. So that's it from my side. Thank you so much. And please do watch the video and keep asking queries.